Welcome back to Lamb's Cryptoverse, and today we're going to talk about 7 charts, 7 days. And let's get started. Whoa. We don't want that. Here we go. For some reason it keeps hiding me. I don't know why it's doing that. Okay, so the first chart is U.S. investor sentiment. And these charts, by the way, are brought to you by Charlie Bellello. He does a great job at labeling charts, so why should I reinvent the wheel, So the first one, again, is the AAII. That's basically the Association of Investors, and this is the sentiment poll. This is a contrarian indicator. As you know, I just love contrarian indicators because you don't want to be running with the herd. You want to be somewhat against it. You don't want to be going against it too much because you can get run over. But you want to be able to, take a look at that herd from above and see where it's going and think about doing opposite because the herd is sometimes right. So in this case, I don't know. So basically, everyone's really bearish. Just as he noted, we have a record 36 consecutive weeks where bears are greater than bulls. This is something, my friends, that doesn't make sense to me because I do my own sentiment index and it's not this bullish. Remember, when there are this many bears, it's a contrarian indicator, so you need to get bullish. But I don't see this. I use another data source. I use the Investors Intelligence data source, which is not reconciling with this. It's not showing the same story. And typically, when you have such a big bull market like we did in the 2000 bull market, the tech wreck, it usually takes years for investors to get bearish. So what scares me about this poll is that it's not done in a manner that's consistent and repeatable. And I believe you can actually vote twice, so 3 times. So it's not a poll that you can use over and over, I believe. I'm a little circumspect of the methodology, so I'm not gonna take this in a serious light. I'm taking this with a grain of salt. Okay, so I would worry about this. I would like to see, and I mentioned this in other videos, I would like to see other sentiment polls like the Fear Greed Index mimic this. And we're seeing a complete opposite. If you look at the Greed Fear Index, we're at greed. So this is not coinciding and not making sense with this. So let's go to the next slide. The Volatility Index. This is something I want to show you in regards to this previous chart. This chart is showing that there's a lot of bears, and when you have a lot of bears, you usually get a lot of fear when you look at the Fear Greed Index, and you usually get a lot of a much higher VIX. So we're not seeing that. So that's what I'm talking about. You need to see some consistency with these charts. And here, Charlie Bellello has a beautiful chart taken from white charts, and he's labeled it. And he's shown all the short covering rallies. We had a 90% rally, 13% rally in March, April, 10% rally in May, 20% rally in July, and now we've got a 17% rally from the October bottom. I've been lucky so far. I've been able to pinpoint nearly every single bottom and top of these rallies. And now I'm doing videos, so you can actually go back and verify that I've actually pinpointed some of these. And I remember in October, I was somewhat bullish. But I remember saying I wasn't really bullish, extremely bullish as I was in June, because so I was moderately bullish. And I wasn't extremely bullish because the Crypto Fear Index, it was at a good level, but it wasn't at extreme fear. It was at fear. It was around 20. I was hoping it to reach another bottom around 8 something or 10. Yeah, you got to be really disciplined with this stuff or you can lose a lot of money. So now I remain somewhat bullish, but obviously I'm not as bullish as I was here in the bottom of October. And I'm starting to I'm much less bullish than I was because CNN Fear Greed Index is at greed. And you don't want to be buying into the market that's at greed. But I still think we can go higher for the next week or two, but then it's going to get tough. It's going to get really tough because we're breaking 200-day moving averages. We're breaking all kinds of averages for Fibonacci, Bollinger Bands, and it's not just technical analysis. The sentiment, and then, as I mentioned in previous videos, I think we're going to reach phase 2 of this bear market. And phase 1 is where the price to earnings ratio compresses. Phase 2 is going to be where the earnings estimates get slashed. And I think we're very close to that. And the key is to look at where the bond market is, meaning treasuries, and look at where the ISM is. Speaking of the ISM, the Chicago PMI is diving. It's going down fast. But the problem is the actual national PMI is not declining quickly. We did get a decline last month from 50.2. Maybe I can make this larger for you. Let's see if I could do that. It was 50.2 in October, and we went down to 49. And I remember the Treasury bonds rallied and rates declined, including the 30-year rate declined when this came out. So the market is sensing that we're about to have a recession, but still, I had expected this number here to go down even lower, from 49 down to 48, 47, or even lower, mimicking what we're seeing with the Chicago PMI. But that hasn't happened yet. And if you recall, I said that was my biggest mistake of the year, is I expected all these economic indicators to decline quicker, and I expected bond rates to decline faster, especially long-term bond rates, and that's where it was wrong. But as soon as I put out that video of how I made the mistake, where the yield curve is not inverting quick enough and bond rates, long-term bond rates are not declining quick enough. As soon as I made that video, long-term bond rates started declining quickly. And you can see here, Charlie below has shown the 30-year bond rate and the 10-year bond rate started declining rapidly in November. And that's, of course, when we start seeing some weakness in economic growth from the soft data, meaning ISM national data, as well the Chicago PMI data, and anecdotal data from companies like Target, Walmart, and FedEx. We mentioned a whole bunch of these companies, and I don't need to tell you, but tech companies have been laying off people like crazy. And second to last chart, this is showing the PCE index. As you know, this is the Fed's favorite inflation index. It's coming off its high, but I think it's coming off its high too slowly. It needs to go down faster. The Fed is not going to stop raising rates, or by the very least, it's going to hold them starting next year. It's going to do that. It's going to hold rates or raise rates if this doesn't come down. This needs to come down much, much faster. And it's not going to come down because unemployment rate is at 3.7%, and it needs to go up at least 50%. We need to see wages come down and the unemployment rate go up. And I want to introduce to you something new. What I mean by that is something I do not understand. I expected NG stocks and oil prices to go down around now, because I thought we were going to have a recession. And I was right about oil. Oil's been going down quickly, but I was incorrect about energy stocks. Energy stocks are up 68%. That is amazing for 2022, and they're staying high in the second half of 2022. And I always say two things. Number one, the bond market is always right? The Treasury Market speaks the truth. And I always say that if you're not sure where something's going to go, like the energy sector, you should always look at the stocks, not the underlying asset. In this case, crude oil. But the opposite is happening. The underlying asset, crude oil, is going down quickly, even though there are tight supplies, according to Goldman Sachs. But the energy stocks are strong. So I'm not sure what's going on. Maybe everyone's listening to Goldman Sachs' Jeff Curry. I'm a big fan of Jeff Curry, but I think he may be wrong in this case. I think that even though we have tight supplies, especially in Europe and even the United States, we have very tight supplies of strategic reserves or inventories. So even though we have tight supplies, we're also going into recession, and I think that's going to be a greater factor affecting energy prices and oil stocks. So another person to listen to is Citicorp. I'm a big fan of Ed Morse, and he's been correct in this area. He's acknowledged that we have tight supplies, but he is worried about global GDP growth. So I don't know who's right, but so far it looks like energy stocks do not want to come down. So it's very surprising to me. Well, that's all, folks. I hope you enjoyed this. And please come back and like us. Bye-bye.